Stop loss is a widely used term in the stock market, which refers to an order placed with a broker to buy or sell a security when it reaches a certain price. To put it simply, if you purchase a stock at 30 Australian dollars and place a stop loss order at $19, the stop loss order will be executed when the stock price hits $19 in order to mitigate further losses. And the same could be applied to the buying of a particular stock that is not currently in your portfolio. So stop loss orders can be quite useful as a safeguarding tool for investors, but it's not black and white. So in this segment, I'll take you through what you need to know about the strategy. But first, make sure to subscribe to our channel and to click the bell icon to stay across the latest videos from Kalkine. So what should investors consider while setting up a stop loss order? The stop loss order should be derived in such a strategic way that it limits losses. A stop loss order placed at $24 for a stock purchased at $30 limits downside capture to 20% of the original position. This is known as the percentage method. It's important to know where to place a stop loss before you start trading in a particular security. There are theories that are based on universal placement, which means executing 6% trailing stops on all securities. Others employ securities or pattern-specific placements, such as average true range percentage stops. Another common method is the support method, which involves hard stops at a fixed price. This method requires experience, since investors need to find out the stock's most recent support level. Once figured out though, the stop loss order can be placed just below that level. Moving average is another common method. In this method, investors place the stop loss order just below a longer term moving average price. Swing traders are also known to use a multiple day high or low method. It includes placing stops at the low price of a predetermined day's trading. The other critical factor to consider while setting a stop loss level is volatility. Volatility can be analysed to place a stop loss outside the normal fluctuations. It can be done by measuring the typical price movements on a particular day. Thereafter, investors can set stop losses and profit targets based on those observations. It's also important to keep in mind that stop loss orders play no role in active trading. Also, stop loss orders don't work in the case of large blocks of shares. Investors must keep an eye on brokerage fees, since brokers can charge different amounts for different orders. And investors should never assume that the stop loss order has been executed, and instead must wait for the order confirmation to be sure. So what else should investors consider? Well, investors should be clear about their risk appetite before going for a stop loss strategy. There are securities for which retracements are common. These require more active stop loss orders. Even as stop loss is about risk management, it may not guarantee profits for investors. So before proceeding with a stop loss strategy, it's important that you understand the pros and cons of the risk management tool. If you enjoyed the information contained in this video, then make sure to like, share, comment and subscribe, and don't forget to press the bell icon to stay across the latest videos from Kalkine. If you'd like any further information on stop loss or to broaden your skills across business and finance, then head across to kalkinemedia.com. I'm James Preston for Kalkine.